Dave Ramsey says that if you have some money lying around right now, you should buy your mutual fund tomorrow. If you need to invest today, do you recall the uncertain period that followed the 2008 financial crisis? Fast forward to the present, when the S&P 500 is hitting record highs and pointing to a strong year ahead. A recent Reuters article perfectly encapsulated this feeling by demonstrating how the S&P 500 has risen to previously unheard of levels due to expectations of lower interest rates and strong growth. In the meantime, Goldman Sachs research predicts that the S&P 500 will return 6% in 2024, indicating that even with high equity values, there are still good investment possibilities in the market. These observations provide a fascinating backdrop for our conversation today. We'll go into great detail about why 2024 is a great year for investors rather than just another year. These insights are supported by reliable research and are derived from Dave Ramsey's advice. We'll also discuss the implications for your portfolio, the reasons you might need to act immediately, and how to make wise investment decisions this year. All set. Let's get started. Let's dissect this. History provides some important clues. The S&P 500 began to rise after extremely difficult times, such as the 2008 financial crisis, when the economy took a serious hit. By 2020, it had increased by over 400%, which is equivalent to turning $1 into $5 over those 5 years. As we see the S&P 500 reach new highs, it suggests that we may be at the beginning of another phase where things keep getting better for a while. Let's now add a few facts. Studies indicate that the return on investment, or the amount of money you make, is typically between 10 and 15% in years when the S&P 500 breaks new records. The stock market has historically trended upward, rewarding long-term investors according to historical average yearly returns. But what exactly is driving up the score, you ask? There are many reasons contributing to the increase. These days, artificial intelligence and technology are major players. It's not just about cashing in on a fad. These developments are changing our lives and careers and helping the economy grow. Things are also beginning to look up. The Federal Reserve is beginning to see a slowdown in inflation or the rise in prices of goods and services we purchase. This is similar to the economy's thermostat, signaling that further interest rate increases may not be necessary. High interest rates have the potential to slow down the market, so this is good news for investors. For those considering investing in the S&P 500, it's like a green light indicating that now is a good time to start riding the market's momentum. And the solid ground of tech growth is like a double thumbs up. Put differently, if you've been holding out for a signal to begin investing, this is it. The market is strengthening, and there are lucrative prospects available. Keep in mind that investing is all about the long term, and everything appears to be going well right now. Let's examine a few historical events and the lessons they might teach us about taking advantage of chances when things are uncertain. First, think about .com. Burst bubble investors faced difficulties during the beginning of the millennium, as the S&P 500 fell by about 50% between its peak in 2000 and its low point in 2002. However, by the middle of 2007, individuals that continued to invest or bought at low prices had made significant returns in the market. The S&P 500 had achieved new highs and regained all of its losses. The significance of patience and long-term planning in investment is highlighted by this cycle of decline and recovery. Go back to the financial crisis of 2008, which was yet another crucial time for investors. From its peak in October 2007 to its lowest point in March 2009, the S&P 500 declined by more than 56%, but the subsequent healing was impressive. Despite the effects of the COVID-19 pandemic, the index had more than tripled by 2020. Investors who understand that the market is cyclical and who make their investments during those downturns frequently see large returns. By 2013, the index had doubled from its 2009 lows. These past examples demonstrate the market's resiliency as well as the opportunities that downturns can bring. They show us that although the market's short-term fluctuations can be erratic and unpredictable, investors have historically seen increases in value over the long run. This demonstrates how crucial it is to maintain knowledge, exercise patience, and have a long-term perspective, particularly in times of market volatility. Here's what Dave Ramsey has to say about this specific concern. Waiting until after the presidential election in November to do your investing is probably a dumb idea. Dave Ramsey is pretty clear on this. If you have some extra cash, it's smart to start investing it right away. You might be wondering, though, should I wait for something big like the presidential election to happen first? Well, history shows us that waiting around for the perfect moment usually means you'll miss out on some good opportunities to grow your money. Now, if you're considering taking all of your money out because you read some headlines, don't do that either. We discovered that if you simply ride this roller coaster, eventually you'll hit new highs and records, and then it will go down, then rise, and then it will go down, then rise. This is how life functions. The stock market has a tendency to rise over time, despite its tendency to fluctuate greatly in the near term. This is evident if we examine the performance of the market during election years. It's noteworthy to note that regardless of which political party wins, the market typically ends the year higher. Therefore, holding off on investing until after the election may not be the wisest course of action. Now let's briefly discuss numbers. The concept of time in the market as opposed to timing the market. Basically, if you're not already invested, you'll miss some of the best days in the stock market that seemingly appear out of nowhere. According to a J.P. Morgan analysis, you would have missed the top 10 stock market days in the previous 20 years. Compared to simply staying invested, your returns would be significantly lower the entire time. And here's another awesome benefit of starting early. Compound interest allows you to earn interest on the money you've already invested. Investing today makes sense for another reason. The sooner you start, the more compounding you can earn. Thus, if you're considering holding off until the following major news event, such as an election, keep in mind that the market is always changing, so the longer you wait, the more opportunities you may lose to invest. Now permits your money to start rising and gets you into the game. The market will undoubtedly experience ups and downs, but historical data indicates that over time, an increase in value is more likely. It would be impossible to discuss investment options without mentioning real estate. Like the stock market, the real estate industry is exhibiting strong growth potential. A housing shortage and shifting interest rates, which define the current market dynamics, create favorable conditions for potentially profitable real estate. Real estate investments are not going to decline. In fact, there is a severe housing shortage. Dave Ramsey makes this claim on real estate investing. The severe lack of housing is one of the main factors propelling the real estate industry. According to the National Association of Realtors, there is an alarming shortage of more than 5.5 million housing units in the U.S. This shortage has been growing over the previous 10 years as a result of underproduction. According to the most recent data from Zillow, the shortage is driving demand to previously unheard of levels, with median home prices climbing by 16% annually. This pattern suggests to investors that property values may rise, making real estate an alluring avenue for investments. Preferences for residential real estate have changed as a result of the COVID-19 pandemic-accelerated remote work revolution. According to an Upwork survey, 36.2 million Americans are expected to work remotely by 2025, which would increase demand in suburban and rural locations as individuals look for more space and a higher standard of living away from congested city centers. PropTech and other technological innovations are altering the way real estate transactions are handled, opening up new opportunities for investors in real estate outside of typical urban markets. Real estate investing is becoming more accessible as a result of online platforms streamlining the purchasing, selling, and property management procedures. A Deloitte estimate states that $23.8 billion was invested in PropTech businesses in 2021, demonstrating the industry's explosive expansion and the potential for technology to improve the returns on real estate investments. Energy efficiency and sustainable living amenities are becoming more and more desirable in buildings, and as a result, both tenants and buyers are placing a premium on them. There is a renaissance in the vacation rental business. This trend offers a profitable chance for investors in popular tourist destinations to profit from the rising demand in the business sector for short-term lodging. The demand for warehouses and distribution centers has caused the record low vacancy rate of 4.4% for U.S. industrial and logistics space in Q4 2021, according to CBR, which is a result of the growth of e-commerce. This approach emphasizes how crucial it is to begin investing right away and maintain a growing portfolio. By distributing risk over several investment kinds and enabling you to make informed selections, diversification serves as a safety net for your financial health. Perhaps a financial advisor might help you investigate the markets more successfully. Ramsey's approach is a workable manual for consistently increasing wealth despite changes in the market. I'll leave you with two things to think about. Are you ready to start investing now, laying the groundwork for your future financial security, and how will you diversify your holdings to make sure you're ready for whatever the market throws at you? Recall that wise choices and calculated actions make the road to financial success simple. Let's embrace the Ramsey technique in 2024 and make investments in our futures. In conclusion, incorporating Dave Ramsey's prudent principles into your approach to stock market investing as a beginner can set a solid foundation for long-term financial success. By emphasizing the importance of disciplined budgeting, emergency funds, and a methodical, well-researched investment strategy, Ramsey's advice encourages individuals to navigate the stock market with caution and informed decision-making. Remember that investing always carries risks, and it's crucial to stay patient and committed to your financial goals. As you embark on your investment journey, continuously educate yourself, adapt to market trends, and seek professional guidance when needed. By following Ramsey's guidance and maintaining a thoughtful, disciplined approach, you'll be better equipped to navigate the complexities of the stock market and work towards building a secure and prosperous financial future.